Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with the Vixologist, Jim Carroll.
Jim is a fantastic follow on Twitter. If you're interested in volatility and the VIX, you have to follow him at Vixologist on Twitter. I highly recommend it. I look at his feed every day and I get his emails. It's really interesting stuff if you're into the VIX. But let's not hear me talk about it. Let's talk about it with Jim. So let's do it. Let's talk with Jim Carroll. Let's do it right now. Jim, welcome to the show. Thanks for being here.
Hey, great to be with you, Dan. Good to meet you, Corey.
You too.
I just want our listeners to know that Jim Carroll is the one and only Vixologist. And that, among other things, besides describing his calling in life, it also is his handle on Twitter, which is now called x.com, but I'd rather call it Twitter because it's easier to figure out what you're talking about. And I highly recommend following him if you're on Twitter, because it's a real education. And that's what I'm hoping that he can help give you today, is a Vixology 101, maybe we could do today. First of all, Jim, you're a new guest, so maybe just tell our listeners a little bit about your background. Like, how does one become a Vixologist? What happens in the years before that?
As it is with many callings in life, a big part of it is an accident. And it goes all the way back. I have to take it all the way back to college, but I'll make it short. I was the son of an Army guy, so we moved every 4 years. What am I going to do? I don't know. I had a couple of part-time jobs, and said, well, maybe I better study economics because that must have something to do with business. And I vividly remember one of the early classes, the professor standing up in front and saying, let's talk about some of the basic assumptions. First of all, we assume rational behavior. And I thought to myself, oh my God, I'm in trouble because, I'm just a kid, but that didn't make any sense to me. I don't know who this guy hangs out with. And I was taking an elective course in the psychology department on organizational behavior. And I said, maybe there's a different angle here. Maybe I can study irrational behavior and how we herd cats and make organizations run. So I switched from econ to psychology. I paid my way through school with an Army ROTC scholarship. So I had a job. That was the good news. I didn't have to compete for a job coming out of school. I spent 4 years on active duty. Fortunately, we weren't shooting at anybody at the time. And so then there I am. And my cousin is the smart one in the family. And I heard she was going back to business school. So she had been accepted at all the top 10 schools. She was deciding between Harvard and Stanford. I said, okay, well, that's, I'll just save the trouble and only apply to those two. How naive was I? But what I discovered when I arrived at Harvard Business School, because they did accept me, was that they loved ex-military people. Because, Harvard is all about training leaders, and their heuristic is that if you were a military officer, you're already a good leader. So, bring them on and let's go. Wound up on Wall Street because that was the craziest thing I could think of doing coming out of business school. Met a lot of people who, had spent some time on the street. Ended up in investment banking at the start of my career. And when the dot-com bubble burst, I had some friends say, hey, Jim, you're a Wall Street guy. What do you do with your money? Do you manage money? Our accounts have been cut in half or worse. Help. So, naive again, there's a naive thread that runs through all of this. I took the Series 65 and started a registered investment advisor called Long Run Capital. And so I've been on this side of the business since 2004, 5, so 20 years now. Mm-hmm. And the whole VIX thing really started in 2015. So literally, 10 years ago. We're celebrating the 10th anniversary of my foray into this crazy world. Um, because so flashback to 2015, right?
Yeah.
Uh, Interest rates are really low, coming out of the global financial crisis. Stocks seem to be expensive. You know, if you looked at the, Vanguard, capital markets assumptions, or you look at, GMO, what they were saying about, where you're going to make money in the next 10 years, it looked pretty
Right.
bleak.
Yeah.
So I'm thinking, holy crap, I need to find something else. And I looked at, all the research that had been done on the commodity markets, because you want commodities in your portfolio because they are a good diversifier. They lack correlation. And my conclusion was, in large part, they lack correlation because when stocks are working, they lose money.
Yeah.
And that didn't particularly sit well with me. And I stumbled across some research about this, this, I knew what the VIX was, but I didn't, know that you did anything with it. This whole volatility complex, as I sometimes refer to it.
Mm-hmm.
And coming out of the GFC, you know, the VIX futures had started trading in 2004. And so during the GFC, there were some people who said, hey, we need to buy these VIX futures things because they're going to go crazy high as the market goes crazy down. So there were some people who, made a ton of money trading VIX futures in the GFC. And Wall Street, in its infinite wisdom, said, hey, we need to productize this thing. So in, I think it was 2009, were the first exchange traded products that sat on top of the VIX futures, VXX and TVIX. We're in that 2009, 2010 timeframe.
Right.
And then
ETF. Right. You're talking about
yeah,
ETFs. Yeah. ETNs.
ETFs that basically reference the VIX futures,
Right.
either long position or a short position. And by the time I had stumbled across this stuff, there were half a handful. SVIXY had come out, which was an inverse VIX futures.
Mm-hmm.
VIXY had come out as a competitor to VXX. We still had the TVIX, which was 2 times long. So you had some toys to play with. And, I just went down this rabbit hole of reading a bunch of academic research. There were a couple of websites, that were launched by people trading this stuff.
Mm-hmm.
And I said, maybe there's some systematic way that I can sort this out and figure out how to use these things. And what was obvious was that, if you could get on the right side of the trade, the returns were crazy.
Mm-hmm.
If you did the short vol trade, right, and short volatility is, akin to being long equities,
Mm-hmm.
right? So S&P going lower left to upper right, you want to be short the VIX futures, and with back in that day, the hot product was XIV. We'll come back to XIV, but it was 1x inverse VIX futures, and but referencing the returns on the S&P, the returns on XIV would be something like 2x what you'd get out of a long position in SPY, for example.
Mm-hmm.
So obviously that attracted a lot of attention, but I did a bunch of work, borrowed a bunch of analysis that other people had done, and came up with a framework based on the term structure to say this is a good time to short it, and maybe this is a good time to be long, but mostly the initial foray that I came up with was identifying periods of time when it was okay to be short VIX futures. And so, started trading that in 2016, just after Brexit, actually. And had a great run, 2016, 2017.
You sure did.
And then, you don't know what you don't know, but
then 2018 happened.
Well, in January of 2018, it's etched in my mind forever. It was on January 16th my system said, close out your short volatility position.
Okay.
So I closed out my short volatility position. It wasn't very good at going the other direction. So the good news was we took our profits and avoided being obliterated in Volmageddon on February 5th. I knew a lot of people who didn't avoid being obliterated on February 5th. But,
what really happened, Jim? What really happened on February 5th?
what really happened was, a combination of things. And I try to stay away from the inevitable conspiracy theories. But the short version is there was literally just too much money betting short on VIX futures, such that, even a relatively small change in VIX, relatively small drop in the S&P triggered a cascade, triggered a bunch of people heading for the exits at the same time on the same day. And they just couldn't get out the door at the same time.
I see.
There was over $2 billion in these short volatility instruments going into that, couple of day period. And that was just way more. That just, the VIX futures liquidity was not there. And let's just say that that there may have been some actors who saw what was going on. And, if I was standing in the window looking to jump, they pushed me.
Yep. Yeah.
There are people out there who look to take advantage of lack of liquidity, and that may have contributed to it. So two things really hit me there. One was, wow, this stuff is tricky and dangerous, but it appears that I've got some systematic approach that kept us safe. But how do I catch that long one? Was one question I had to ask myself.
Mm-hmm.
And the other thing we had rubble. XIV was gone.
Mm-hmm.
SVIXY, which was the other 1 times inverse, ended up being cut in half. So you no longer had the same exposure that you had before. And so I had to essentially pull back and reconsider how I was going to do this. And at the same time, I had gotten to know some people who were deep in the weeds in the volatility world and the exchange traded product world, and got involved helping them essentially relaunch a couple of products. Volatility shares is the business, and the products now are SVIX and UVIX, the 1x inverse and the 2x long. So essentially replacements for XIV and TVIX, because TVIX disappeared during the pandemic. That's another story.
Okay.
So
maybe...
that's how I got started. It continues. I've made some adjustments to how I do what I do, but that's kind of the origin story.
Okay, good. That's a good history there of Vixology. A little bit, intro to it. Maybe let's just tell our listeners what the VIX is, just to make sure we all know what we're talking about.
Yeah, ground everybody and what we talk about it in our newsletters and whatnot, but I'm sure we have the Vixologist here. We need his simple definition.
Right. Yeah. Presumably you're going to be better at this than we are.
Well, yeah. So let's start with the VIX, which is kind of the sort of ground zero of all this stuff. And essentially what VIX is designed to do is to give a composite measure of the premium reflected in a strip of both put and call options on the S&P 500 index. So think of and this is SPX. We probably don't have time to get into some nuances that we could get into, but Um, you know, so VIX is referred to as the fear index, right? VIX reflects the activity in that in the call and put options for the S&P. It tends to go up when people are buying puts. They're concerned about the market, or the market's already rolled over and they're buying puts to protect themselves, and the premium paid for those puts goes up. Okay, well, that means that the VIX is going to go up. Now, what some people don't recognize is that there's another circumstance where the VIX might get pushed higher, which is when everybody's going crazy trying to buy call options. Let's go back to the meme stocks, and everybody's buying call options on all kinds of stuff, and that can also push the VIX up, because volatility, really doesn't care whether it's volatile to the downside or to the upside, right? So the VIX really reflects people's enthusiasm for buying options on the S&P. Typically the VIX really goes crazy in conditions where investors are fearful. August of last year, this latest tariff tantrum,
Right.
and that put buying activity will drive the VIX higher. The VIX can't be traded. Okay. The VIX is literally just a quotation from the CBOE based on 15-second reading of option prices on the S&P 500, and so that's what it is. So in 2004, they decided, well, let's create some tradable instruments around this, and VIX futures were launched. And so we now have VIX futures contracts. Right now we just dropped May and added January to our term structure. So we've got a string of VIX futures contracts that people can buy and sell. We've got options on those VIX futures. People get confused sometimes when they hear VIX options. The options do not translate to the VIX itself. They translate to the VIX futures.
Right. They're
So
futures options, right?
They are futures options. So people sometimes get confused about that. But so now you have a bunch of tradable instruments around this VIX thing in the futures and the options, and then we have the exchange traded products that were created to make it easier for people to take a position again in the underlying VIX futures. The VIX futures, like any futures contract, whether it's oil, gold, whatever it is, those contracts every day are one day closer to expiration. So if you own a futures contract, every day your exposure is slightly different than it was the day before. So what these exchange traded products do is they make that daily adjustment so that you have a constant exposure to the underlying futures contracts, which has some benefit to it from the standpoint of being a little more predictable. But again, people can do what they want to do in different ways. Some people want to play volatility using options. Some people want to play volatility using futures. I made the decision to play volatility using the exchange traded products.
Okay. Now, I wonder if this is a good moment to talk about the VIX mix, which is something I look at every day. I'm addicted to it now. I have to look at it every day, or every time you send me an email. It seems like it's daily, right? I don't think you've missed a day.
It is pretty much daily.
Yeah. So, what the heck is the VIX mix? How did you come up with this? And is the VIX mix part of your system that, told you to get out before the February Volmageddon in 2018, or when did you do this?
The VIX mix is more recent than that. But what I came to realize was that, every day I was keeping track of a whole bunch of different things. And I thought, well, what if I kind of put all these things together and created a composite indicator that pulled measures of volatility from different aspects, different perspectives. And I had actually been approached by the people at Substack because they had been following me on Twitter. And they said, you're putting up a lot of interesting content. Have you ever thought about, doing a blog, bringing it over to Substack? And I said, well, not necessarily, but I thought about it and decided that, that's what I would do. Have a home for all this work that I'm doing on a regular basis anyway. And then the idea of this composite indicator, came to mind, and I spent some time developing it. And so what the VIX mix is, it's a combination of right now 17 different perspectives, if you will, 17 component indicators, each one of which, takes a different perspective on some aspect of volatility. It could be the VIX futures term structure. It could be the CBOE volatility term structure. The CBOE, is the home of VIX, but it's also the home of, and VIX is a 30-day measure. It's also the home of VIX 9-day, VIX 3-month, 6-month, 1 year. Don't get me started about zero DTE because it's out there, but I don't pay attention to it.
Okay.
I let the smart kids play with that. But again, you have this term structure out of those CBOE indices, and watching how that shifts and what the dynamics are there, can give you some insights. Medium-term VIX futures versus short-term VIX futures. Again, how is all of this stuff responding to day-to-day changes in the market? And when you add it all up, is it telling you something? And so essentially, I have 17 things that are all percent ranked based on their history. Where are we relative to the history of this thing? Add them all up. And then I sort of arbitrarily said, okay, over here, these are bearish readings, and in the middle, these are neutral readings, and over here, we got bullish readings. And, one of the things that you see occasionally, because nothing works 100% of the time, right, is you'll see, the equity markets behaving one way, and this VIX mix thing behaving a different way, right? If we go back to July of last year, before the August, sort of flash crash, if you will.
Yeah.
The S&P was making new highs, and the VIX mix was saying, yeah, we're kind of feeling neutral. We're not feeling that bullish sentiment. And, the S&P decided that the VIX mix was right, and came down, and so it provided a little warning signal, and sometimes that warning signal is kind of a yawn, and sometimes that warning signal is pretty useful in terms of protecting capital. And the other one is obvious. There are times when the market has cratered, and you're thinking, geez, wow, this is bad. Mm-hmm. And maybe the VIX mix starts to perk up. Maybe people are taking hedges off. They're beginning to adjust their positions. And so under the surface, sentiment has changed. Volatility has receded a little bit, even in advance of the market turning around. So you can see divergences in both directions. Again, it's not always the case, but it can be useful.
Okay, yeah, you sort of answered the question I had, which is, what happens at tops and bottoms, because presumably you'd be in, deep in bear mode at the bottom, right? When you'd want to be turning around, but you're saying that some of the components that you have in there help you, can be useful. I think that's a good way to put it, in determining when it's time to kind of turn your bets around and take off your shorts and think about going long.
Right.
Okay. And right now,
And again, that's a very tactical use of it.
yeah,
And not everybody's a tactical investor. I think
right,
the other thing that I suggest to people is, let's say you're just hey, Dan, Corey, I don't have time for all this. I'm a buy and hold investor. I'm long term.
yep,
I want to, I'm making some money. I'm relatively young. I want to just keep putting money into the account and watch it grow. Well, let's work on your psychology then. Let's make sure that your risk tolerance is what you think it is. And so something like the VIX mix, you could say, okay, well, we're going through a bad time. I'm prepared for that. And maybe I'm even going to say, okay, if everybody else is freaking out, maybe I want to put some more money to work. But I'm not going to allow myself to be shocked by what's going on. And so even for longer term investors, I think just having something that says, you might want to prepare yourself for an increase in volatility. It doesn't mean you have to do anything about it, but psychologically, you might want to brace yourself.
I'm glad you said that, Jim. I'm really
Yep.
glad you said that, because that's been a big message of mine in one of my newsletters, and like almost every week in the Daily Digest that Corey writes the other 4 days. I just do it on Friday. Is to be by all means be a fundamental based, bottom up long term investor in great businesses. Right, that's where you're going to get your best compounding. But we know how people behave, don't we? They sell. They sell when they should be buying, and they buy when they should be selling. And I feel like you're right. The VIX mix can sort of help prepare you. And I'm constantly telling people, prepare, don't predict. Right? Just prepare for what's out there. Right? Which is sort of which I believe is the mentality of a great trader. They don't say, I know I'm right. They manage their risk and say, this looks like a good bet. It's a totally different mindset. And
Yes.
this kind of helps with that. But I think I cut Corey off. I thought he was going to ask you a question. Nope.
I mean, no, but I was just gonna say. I mean, we've written recently. After these VIX spikes, the long term returns. You go 1 year, 2 years out. It's pretty good. I mean, it's pretty great actually.
Yeah,
So
and you're absolutely right. And there have been a few of these little data points. The only time I object is when the somebody says, hey, when the VIX goes to 50 and then goes back under 20, 1,000% of the time you make $1 trillion. Well, the N, the N on that set of occurrences is 4. Going back to 1990, it's happened 4 times.
Okay.
right.
And oh, by the way, how many 10-year periods has the S&P lost money? Not very many. So yes, I think if you can be brave in the middle of a market meltdown, and you do have an extended holding period and an ability to hang on for an extended period of time, you're going to do great. I sometimes kind of shake my head at these tables that are produced that say when this thing happens, whether it's bad things or good things, I just statistically half the time we're talking about small data sets. So I just say, yeah, but take it with a grain of salt. And oh, by the way,
that's a great point.
there are 2 other things that are important to understand with this whole volatility thing. You get a spike in volatility, and that reflects the market going down. So okay, we should buy that. And again, I think that usually works out. And I would just say 2 things. One is that sometimes that initial shock has aftershocks. So again,
Yeah.
fine. You want to buy, go buy, but prepare yourself for some additional volatility.
Right.
The
Mandelbrot. That's Mandelbrot 101. Volatility clusters. Be careful.
volatility clusters. The other thing that I occasionally remind the audience on Twitter is that, and again, this stuff only goes back. VIX only goes back to early 1990s. So again, we're dealing with relatively small data samples here.
Mm-hmm.
But the other thing I look at is just taking a simple 1-year moving average of VIX and saying, is that 1-year moving average above 20 or below 20? 20 is roughly the historical average for VIX.
Mm-hmm.
Because if you can look back, when that 1-year moving average of VIX gets above 20, again, you may be looking at a cluster.
Mm-hmm.
You may be looking at a period. If you go back to the Russian debt crisis, long-term capital management, the Asian contagion, you had a series of events during a period where that 1-year moving average of VIX was above 20. The global financial crisis, we got above 20 and hung out there for a while. Interestingly, I look at the serious VIX spikes that include 2011,
mm-hmm.
which was coincident with the U.S. government debt downgrade, but more coincident with the whole Euro debt crisis.
Mm-hmm.
That was kind of isolated, actually, and we were not in what I refer to as a high vol regime. 2015, again, August of 2015, when we had a big spike in volatility, that was relatively isolated. And as we got into 2016 and 2017, it was a great time to actually be short volatility and long stocks.
Yeah.
So I look at these things, both in isolation and in context, to give myself a sense of what I think the probabilities of things calming down or things staying volatile might be.
Yeah, you can see, like, if you just take a VIX chart back to whatever 1990, there's these. You can see clusters, and you can see periods from. I'm just going to eyeball it here on a Bloomberg chart that I'm looking at. From just say 1998 to say 2002 or so.
Mm-hmm.
The bottoms are all higher, right? And the tops aren't as big as like 2008 or 2020 or whatever, but there's it's spiky and the bottoms are all higher. You can see the whole bottom, and then you get this nice downdraft down to about 07 or so, right, the top of that, and then whoosh, we're off to the races.
Right.
And the bottoms are actually higher all across from 07 to, I don't know, call it 11 or something.
Mm-hmm.
And then so you can see that something's going on in the world. People are scared, and they stay, let's say, somewhat more scared than normal, for an extended period of time. And
Right.
I feel like when you look at what's happening now, starting maybe with a bottom in like May of last year, that
Mm-hmm.
we're, those bottoms are steeper. We're getting higher, and I think we're headed into a period of higher volatility, because I think that's what happens when, all of these forces converge on a market that is extremely expensive compared to history by several different measures. I think I've written literally about something like 20 or 21 different measures, and the market's like epically historically expensive based on nearly every single one of them, and above average on the other one or two. So I that's what I'm expecting. I've been telling people it's going to be more, there's going to be more of this. Like, people act like April 8th was, whoa, Trump relented, and there was a little bit of a hint of bond market, vigilantism, because he mentioned it the next day. He was like, oh, people are
Right.
freaking out in the bond market. It ain't over. I don't think it's about tariffs either. It's about those fundamental imbalances that can't go on forever. And tariffs are just one way to handle that. So
Yeah, and I'm
your
a
tools
terrible
are
macro
important.
guy.
Go ahead.
I'm a terrible macro guy, but what I say is, look, you're entitled to your own views of the world, your own opinions, but you can't be surprised if these volatility episodes continue.
Right.
If we
Yeah.
see several more of them, you can't be surprised.
Yeah, but hang on a minute. The Vixologist says he's a terrible macro guy. I mean,
Oh
equities
yeah.
generally are not a great macro asset. Like you want to watch bonds, right? That's the macro asset. But if there is a macro view though that seems like, I mean, just intuitively, I would think it would be through volatility. But no, you're a terrible
Well,
macro guy.
well, if you want to say that looking at the world through this lens is a macro perspective, God bless. I'll take it.
Okay.
Uh,
Right, because
but
it's especially the instruments that you're doing, it's like a derivative of a derivative of some, so um, that tends to be like macro goes into those places and just blows them up or, melts them down or whatever, inflates them like
well,
crazy.
which is fine,
Yeah.
And I guess where I draw the distinction is, you take sort of legendary macro guys, whether it's Hooter Jones or Soros or some of
And
these
yeah,
folks who come up with these theories and this piece is going to move and that's going to cause this thing to happen and this other thing to happen and this other thing to happen.
right.
And it might unfold over the next 20 years.
Yeah, and therefore let's short Malaysian palm oil futures, and then they make 1,800% in a week. Yeah, I know what you're talking about. Yeah.
So, well, but so, my perspective on this is, I kind of let the numbers do the talking. I don't come up with a grand theory of what I think is going to happen. I let price tell me what I want to do, when I want to do it. I sometimes refer to it as just, humble swing trading of, exchange traded volatility products. And
Yeah. Do you?
sometimes those swing trades, can extend themselves to weeks or months. And sometimes they're over really quick.
There may not be an answer to this, but or an easy one, but the uh, just as far as what the VIX or what the VIX mix, like who is it measuring, right? Like, is it mostly institutional? Is it more retail nowadays than you've seen in the past? Is it, do you have like an inkling of what it's actually representing?
Well, I think, one of the things that, I try to pay attention to are smart people who have an insight into, what is commonly referred to these days as the flows. Who's doing what to who in what size. Is retail driving the bus? Is institutional driving the bus? In the volatility world, uh, there's a lot of institutional volatility selling
Oh
these
yeah,
days.
yeah.
And some of it, has been in place for quite a while, right?
Hmm.
Um, whether it's income enhancement, right? You've got this portfolio of equities. We should be selling calls against that. Um, you got all kinds of strategies that use derivatives to try to squeeze some premium out of the volatility market, typically by selling options. Um, you know, that volatility selling, tends to be a suppressant until it isn't. And I think one of the reasons that we see, kind of these spikes out of nowhere,
Hmm.
August of last year, go back to the Fed meeting in December, which, we've all forgotten. But, there was a couple of days spike in volatility that was very significant. Um, and then we've got the, temper tantrum, et cetera, et cetera. Um, we've got institutional volatility selling that dwarfs anything retail might be doing. Um, you know, Retail's really not a factor in the markets that I follow.
Okay.
Historically you had, when we got to February of 2018, that was sort of the peak of retail participation in the volatility markets.
Right.
And those people were carried out. The few survivors have probably not come back. And
Yeah.
it's interesting though. We have seen some products, and we're seeing some newer products come into my world.
Mm-hmm.
JP Morgan came out with an exchange traded note, VYLD,
Oh, BYO.
which is again sort of tethered to the VIX futures, but they've done it with a different construct that is meant to be less volatile. Frankly, I have no idea what the real use case is for the product, because to me it looks like an S&P kind of return in an exchange traded note that JP Morgan has. I don't get it.
Yeah.
A couple of other people have recently filed at the SEC for volatility products that look a little bit like Frankenstein's monster to me. We'll see what happens. There's one very popular product that and I have great respect for the team at Simplify,
I'm just
and they
looking
have
at
a
that one.
product.
Yeah.
Yeah, they have a product called SVOL,
Mm-hmm.
which is an actively managed short volatility product that also incorporates some hedging, and really is designed to capture the roll down in VIX futures. So they'll short a VIX futures contract, they'll cover that short position, and they distribute income from that operation. So they view it as kind of an alternative income product. So there's some different takes on it. I tend to be a little more of a purist in terms of the VIX futures and products that directly tie to the VIX futures, because if I'm giving money to an active manager,
Mm-hmm.
I may or may not know what they're doing on a day-to-day basis, and that kind of unnerves me.
Yeah, I'll say. Especially when it's one thing to not know the secret sauce of a stock picking strategy, but it's quite another to not know the secret sauce of a derivative strategy. For my way of thinking, I always
Yeah,
so
look,
when I hear
if
derivative, I think of embedded leverage. Just
yeah, well, and there is embedded leverage. Okay, we're talking about products that have embedded leverage,
mm-hmm.
um, and because that's what futures are. Um, and if somebody has a strategy to use these things, and they're consistently applying that strategy, then I can say, okay, I can get with that if I understand the strategy, if it's not a black box, right? That where there's no transparency, and that's being applied consistently. That's what I get with the exchange traded products that I use, which are primarily SVIX and UVIX. I know what they're going to do every day, and so there's no mystery to me.
Mm-hmm.
And so I feel comfortable, using those to implement the strategy that I have.
Right. Jim, this sounds like something that it's really interesting to hear about it, but I almost feel like telling our listener, don't try this at home unless you really know exactly what you're doing. And it sounds like, you've spent a career, or a good part of one, as you told your origin story, a good part of a career just focused on this. I mean, you know, that tells me something. Um,
I sometimes refer to what I do as juggling nitroglycerin.
that's great.
You know,
Yeah,
if you get really good at it, it can be profitable and entertaining.
yeah,
But one false move and you can blow yourself up. And so yeah, this is not you know uh, This is not something that people should just cavalierly, launch off into. Um,
And the point
because
about the point about leverage though is worth amplifying a little bit because, like, let's say you trade gold futures, and let's say one gold contract is worth $1 million. Well, if you got $1 million in your futures account, you can probably trade 10 of them or something, but or 20 or whatever. But you could also trade it unlevered by buying one contract, right? But it kind of almost negates the purpose of
right, where's
futures.
the fun in that?
Yeah, that's right. So,
Yeah.
so so then it becomes this risky levered thing. So we wind up here with everybody who trades anything saying, how do you control risk? Is it position sizing, trailing stops, the sort of typical trader tools?
Yeah, the answer for me is both of those things. And the one thing I don't do, the way I run my strategy is I don't hedge explicitly. So if I'm short volatility, I'm short volatility. I don't buy VIX calls as a hedge against that, or buy S&P puts as a hedge against that.
Hmm.
Because to me, the way to hedge a strategy is to position size. And so, when I'm working with clients, and if I've got somebody who's interested in having a little bit of spice in their portfolio, we're going to size that such that the volatility of the strategy itself, does not, cause their portfolio to get wonky.
Okay, so
Yeah.
I don't
That's
want
what I was going to bring up.
to.
Like what
Yeah,
when you're managing other people's money, obviously how
yeah.
does that for a lot of people, how does this fit in like percentage wise, or
It's going to be
or
it's
not?
going to be a relatively small, yeah, it's going to be a relatively small percentage, and it's typically going to be in a tax deferred location, an IRA account,
Hmm.
because trading this stuff, there's no such thing as long-term capital gains trading volatility. You're
Right.
you're you're never you're never going to have a trade that lasts 12 months in a day. It's all short-term stuff.
Hmm.
And so while the returns, can be attractive, they're tax inefficient and need to be located someplace that shields the tax impact.
That's a good point.
And yes, from a trading perspective, you know, uh, the way I suggest people think about this is if you know how to swing trade, then you are probably going to be comfortable, in this environment. If you don't know how to swing trade, then stay away, or just provide liquidity on the other side of my trades. Um, that's okay too.
It's okay with you. Probably
Well,
not okay with me.
this is trading.
Yeah.
I do not suggest in any way, shape, or form that using these volatility exchange traded products is investing. It's trading.
Yeah. And there's a lot of that. That opens up an even wider discussion we may not wish to have, but there's so many products now that are very obviously structured as pure trading products, hyper focused on. Now we have one stock products, with leverage, clearly not meant for investment. Clearly, like, it's the market, and many people are talking about this, how the market is this casino now to a great
Hmm.
degree. You mentioned zero DTE earlier. You know, huge casino like
Look,
behavior there.
we have gamified the markets.
Hmm.
Um, whether it's Robinhood or a bunch of other apps. You know, push green for buy, push red for sell. Whatever.
Hmm.
Um, you want to trade options? Will not only will you not pay commissions, but we'll give you rebates for trading options. Woohoo! I get
Yeah.
paid to trade options.
Yeah.
So we've created a very large casino, where some of the people who wander in off the street, are soon separated from their cash.
Hmm.
And maybe they come back, with more, or maybe they are chastened and wander off and do something more productive with their lives.
And
Um,
meanwhile, Jim Carroll's sitting at the table counting cards in his head. Sort of, right? Sort of.
I don't want to discourage people from participating because that provides liquidity.
Jim, that is so subtle. You providing liquidity is a wonderful way to say that.
Yeah.
A wonderfully polite way to say that.
I just saw Robinhood on their app. I had for the first time I saw you could bet on like the NBA playoffs, like a game. Like they just all of a sudden. So you want to talk about casino and betting? Like there you go.
Wow.
Like it's
Yeah.
literally sports betting on the app. So and you could also do
Well,
Fed. You could also do Fed rate, projections and all that
sure.
stuff too.
Yeah.
All right, let's go back. I want to talk about something, Jim.
Okay.
You mentioned, volatility goes both ways, and you were saying, sometimes people go crazy and buy call options, and that can affect the VIX. But generally speaking, though, the VIX is it's like a bear tilted product. Like it's negatively correlated with the S&P 500. I think
Yes.
about 80%.
Yes.
And
Maybe
so,
even more.
why is that? Like, why don't we get when people go?
So
Why doesn't it go both ways?
because, fear is a stronger emotion than greed for most investors.
Of
And
course, I
so
should have known. Yes.
and so it's the activity in the put options, that go the other direction and cause, VIX to go higher when stocks go lower.
Of
It's
course.
that scramble for protection that outweighs people, because there are perfectly valid uses for call options by, any investor who wants to understand how options work, right?
Mhm.
It could be
Mhm.
stock substitution.
Yeah.
We've had a good run. Stocks may go higher, but I want to reduce my exposure, in case it doesn't work out. So instead of owning stocks, I will own some call options. I
Mm.
have less capital at risk. It's capital efficient. It can be a great way to do it. Um, but that kind of activity, again, is probably not going to cause those call premiums to go
Right.
through the roof, right? It's sort of
Yeah.
steady Eddie, thoughtful purchases of call options. It's not chasing call options.
Okay. So it's
But
not a
when people,
technical structural reason. It's just the way humans behave. Is sound
correct, yeah,
okay. I just want
yeah,
to make sure that.
there tends to be, yeah, the skew. To introduce a term that people may or may not be familiar with, the skew tends to go to put options. That the premium for put options tends to be higher than the premium for call options. And so that's reflected in, the VIX moving faster and farther when the markets, go in the wrong direction than when the markets go in the right direction.
Right. And just the dynamic of human beings as you described, they don't tend to they do get quite bullish and quite frenzied in their buying. That is true. But they're mostly buying most of the time anyway. So they're not mostly rushing for the exits and mostly trying to, not lose everything. So I that dynamic, I feel a little funny that I didn't figure it out because I'm always writing about that, about fear and risk and the way people behave. They always do the wrong thing at the wrong time.
It's like, the old movie theater analogy, right? Everybody
Yep.
rushing for the exits.
Yeah.
When the movie finishes, everybody calmly gets up and walks out. It's when somebody yells fire or smoke starts to fill the room that everybody
Yeah.
rushes for the exits and tramples everybody, and that's, when people begin to uh, panic about the market going the wrong direction and try to get some protection in the puts. They're going to chase those puts. And oh, by the way, we also have to remember that the people who they're buying those puts from are almost exclusively very, very, very smart people called market makers
Hmm.
who say, "Oh, all of a sudden everybody's at my door wanting to buy puts.
Yeah.
Maybe I'll raise the price.
Yep.
And so, there's the chase happens.
Right.
That's what we saw if we go back to August 5th, right?
Mm-hmm.
And that, the weekend and pre-market on August 5th when, the VIX got over 60, you know, did it really get over 60? Well, okay, what was happening overnight on
Yeah.
Sunday into Monday morning was, a mad scramble for put protection. And, so Ken Griffin's computers
Yeah.
were saying, they didn't bother waking him up. They just started raising the prices for everything. And it wasn't like there was a lot being transacted. But, when the CBOE computer went to calculate what the VIX should be, the prices had gone up. So it said, hey, it looks like the VIX is 60. As soon as the market opened and liquidity returned, that came down significantly. And the VIX futures
Mm-hmm.
that were also trading during part of that period never got as high as the VIX itself. So, again, one of the things you can do to sort of gauge underlying sentiment is to compare the action in the VIX with the action in the VIX futures.
Right.
And if the VIX futures are not, moving as much as the VIX, I would trust the VIX futures as a better gauge of what's really happening.
Interesting. So, like, watch the front month when something like that is going on.
Yeah.
Rather than the VIX itself. Okay. That's interesting. Yeah, I'm glad you brought that up because there was it lasted for a couple of weeks. People were saying, no, it wasn't really that high. Oh, yes, it really was that high. And it went back and forth, and I never quite figured it out.
Well, and look, the way the CBOE calculates the VIX,
mm-hmm.
it got there.
Okay.
But
Fair enough,
was that a realistic, reflection of what was really going on? And the answer really is not really. That it was a function of that being a Sunday night into Monday morning. We're having computers talk to computers because everybody's asleep. And the VIX futures did not reflect the same level of movement, and that was kind of the tell.
I see.
That so again, had you been long VIX futures going into that weekend, you did just fine unless you held on to them too long. But it was one of those circumstances where people did kind of freak out. And was it the dispersion trade? Was it the unwind of the Japanese yen carry trade?
Yeah.
Was it a crypto hedge fund that got a margin call on Friday afternoon?
Yeah.
Yes. All of those things.
Yeah.
And then it settled down pretty quickly.
Okay, great. Jim, this has been absolutely wonderful talking with you. It's time for our final question, which is the same for every guest, no matter what the topic, even if it's a non-financial topic, same identical question. If you've already said it, by all means, feel free to repeat it. So the question is simple. It's just for our listeners' behalf. If you could leave them with a single thought, a single solid takeaway for today, what would you like that to be?
I think that investors generally need to understand enough about the market ecosystem to reduce the element of surprise. I think a lot of investors, especially retail investors, kind of want to set it and forget it. And even in the advisory community, I see investment advisors who want to put clients into a particular portfolio, conservative, aggressive, moderate, whatever. And I'm going back to the golf course now. And clients may or may not, really understand the vacillations that they could experience in the market. And so I think, pay enough attention that whatever volatility we experience doesn't come as a complete shock and cause you to do something that in hindsight you'll say, why did I do that?
I love what you said, reducing the element of surprise. That is an excellent point. And, thanks for that. And thanks for being here, man. It was so great to talk to the one and only Vixologist.
Well, it's a pleasure to be with you and to actually put faces and names together. And I hope it's useful to your audience.
All right, Jim. Thanks a lot. You're going to be getting a call from us in 6 or 12 months, and we're going to want to check back in with you.
I'll be here.
All right.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.